Okay, so today I'm going to talk about how not to blow up your account, how not to lose all your money if you're getting involved in day trading. Before I do that, just remember to hit the thumbs up button. And if you haven't already, which I hope you have, subscribe to the channel. And remember to hit the notification bell if you want to watch me trading live every single day. I go live approximately 90 minutes before the market opens, and occasionally trade live for the last hour of the market also. So if you want to see me trading live and watch me trading the strategies and the methodologies that I teach, then hit the notification bell. You'll be notified every time I'm going live. In the meantime, this is how I would advise not to blow up your account. Enjoy the video. Welcome back to Day Trading with Tony, and in this video I'm going to talk about how to avoid blowing up your account. So one of the biggest problems that I see consistently from traders is that they get into the market with unrealistic expectations. They have dreams of being rich, and yes, while we do this for money, we do have to keep everything in perspective. We have to stay grounded. A lot of this times this comes down to marketing. You see marketing materials and they'll say, hey, I can teach you to day trade and take $1,000 and you'll have 100 grand in no time. And they show you pictures of people on corporate jets and driving Lamborghinis and all the other crap. And that's not the reality of trading. It's a slow and steady process. You're going to have days where you lose money, not trades, but days, weeks even, where you lose money. But in the end, what you're trying to do is make more money than you lose. And then over time, everything compounds and it becomes a serious business. And that's the biggest problem that I see with people trading. So let's take a stock here. Let's just say we're trading, let's say US Steel, for example, and it's trading at $10. And it makes a move to $9.90. We bought it, it's gone against us. Well, one stock, and I'm not including transaction fees, commissions, charges, that kind of thing, just for simplicity. Okay? If we own one stock, it costs us 10 cents. Well, what happens if we own 100? Well, now we're down $10. What about 1,000? Well, now we're down $100, and so on. And unfortunately, what happens is a lot of amateur or beginner traders, they look at this and go, well, you know, if it went up 10 cents at 1,000 shares, I could be up $100. And that's true. But you're going to have the losses, and the losses for some unknown reason always happen when you're being the greediest. So let's take this $100 loss, and we're now down to $900 from the original 1,000. Well, what was a 10% loss is now going to take basically an 11% gain just to turn things around, to break even. Because 10% of 900 is 90. So you're going to need to gain 11%. And that's where risk and money management skills are so crucial. You don't want to lever up the trade. You want to be as cautious as possible. As a professional trader, your number one responsibility is to protect your trading capital. That means some days you just don't trade. But even if you do and you lose, you take small manageable losses. A lot of professional traders will only risk 1% of the total trading equity. And if your account isn't big enough to do 1% trade and have it meaningful, then you probably don't have a big enough account. And that's just the reality. Some traders will double up on a very good setup. Okay? So, for example, this is a nice ascending triangle, and in an uptrend, we came back and tested it, and there they might risk 2%. They put the stop loss wherever they need to, and they measure 2%, and that's going to be going a little heavier. Okay, so when the setup's a little better, you can do that. It's one way to supercharge your losses. Because even then, a 2% loss isn't catastrophic. 2% on $1,000 is $20, you know. So it's not the end of the world. I mean, you don't want to look at every trade like that, obviously, but it's manageable. Trading psychology is crucial. I can't stress this enough. You must simply be willing to enjoy the process, because if you're looking to make money, you don't need to trade it. You could have other people do it for you, and you don't have to worry about it that way. Okay. If you enjoy the process like I do, then you learn to enjoy the entire process. Even when you're losing money, you enjoy the challenge of it, because that way the money almost becomes secondary. Because if you hang on to the profit and the loss too tightly with your mental capital, and that's something you will spend way too much of your mental capital on, this can become a very exhausting game. You can get something that's called a margin call. If you have things leveraged up too much, for example, you know, whatever your broker offers, 4, 5, 6 to 1 or something like that. Let's say your $1,000 could buy $6,000 worth of stock. Well, there comes a certain point, and it's going to be a little bit different depending where you are and what locations you are. But that margin that you put up $1,000 isn't enough to protect the position, and they'll liquidate you, and it'll blow up your account, and that's absolutely the worst feeling. Many traders have done that, and then come back to be successful. It's not the end of the world, but it is the end of your live trading for a while. This is why you paper trade. This is why you use low margin. This is why you use low risk strategies in the form of money management, risking 1, 2, 3%, whatever it is. This is why you do that, because markets can move in very erratic manners based upon things that there's just no way to see. I mean, okay, look at how loved Apple has always been in 2013, 2015, and then, I mean, it's a pretty big drop there from 135 to 90, you know. And if you're long on this heavily leveraged, meaning that you borrowed shares to buy, then your $1,000, it isn't going to take long before the losses are worth more than your account, and you're done. Okay, there's no more trading. If you build up over time, you can eventually get to this to be a sustainable and large account. And you already have a large account. You definitely need to protect your money anyway, because volatility comes and goes, and we have events where you can get stopped out all of a sudden for no apparent reason. But if you're down 1% or 2, it's not the end of the world. You recognize that where you were wrong, maybe your analysis, or maybe it's time to reevaluate the market. You know, it might be Apple, you know, it could be commodities, it could be Forex. It really doesn't matter what it is. It applies to all markets. You don't want to revenge trade either. That's the quickest way to lose money, because what will happen is you go long here, and then the market goes against you. You end up getting stopped out, and you get angry, so you short, and it goes against you again. It happens quite frequently. It's a great way to pile up the losses from 1% to 2%, and all of a sudden 10%. By the end of the day, you're spending several days trying to get that back. There are different ways to handle this, but I know some traders that once they have a loss, they make it, I can't trade for an hour. You know, that kind of rule. Or they just won't trade for an hour regardless of what they see. It's all about psychology, and if it's, you know, it's got to be a little bit personal for each of you, but understand the dangers of overtrading. Looking for the right setup can get you all the profits you need for the day in one trade. You don't need to make taking 14 trades. If you really want to hyper trade, then go to paper trading account. Okay? It will save you a ton of money. You'll learn something new there, maybe. And that's not a bad thing either. But by all means, don't risk too much on any one particular trade. You know,